Venture Trends in 2024 Outlook with Stanford Angels and Entrepreneurs United. Our group connects the Stanford startup community and innovation centers across the country beyond California with regular remote programming. Thanks for joining us. I'm Sheila Peruva, president of the group, partner at Prime Row Ventures, and a Stanford engineering alumna. We're delighted to welcome top minds in venture capital, Kwon, partner at Cooley LLP, and Ashraf Hebela, head of startup banking at JP Morgan. Note, this session is for educational purposes only and is not intended to constitute legal or financial advice to you in your specific situation. For such advice, please consult with your own legal, tax, financial, and other professional advisors. Welcome to guests Ashraf and Sale. Ashraf, could you please introduce yourself? How does your team work with startups and investors?
Well, first and foremost, thanks for having me, Sheila, and thanks for everybody who's joining in, a special note to Sale for being my partner in the session. So appreciate it very much, and very honored to be with you and such an amazing group of Stanford alums. So my name is Ashraf Hebela, and I work here at JP Morgan in the startup banking division. So I head up our startup bank. I'm an industry manager and the head of the group. We work with startups as I hope you would expect a technology-focused, passionate bank to work with startups, which is first and foremost, we're going to focus on their basic banking needs. And so everything that you'd want out of a market-leading, global, complex financial institution, we can give you. So world-class treasury product. Obviously, when you grow, we'll do credit and venture lending. We offer cards and payments and FX, and then obviously swaps and hedges and all that good stuff. But I think the other great part is that obviously with having a private bank, with our integration with First Republic Bank, we also care about the private side, the entrepreneur, the human behind the company. So we offer various products and services, whether it's financial planning and wealth management on the private side. And actually, once you really, really grow, we're going to offer everything in terms of market-making activity on the ECM, DCM side, M&A, IPOs, the whole thing, and we're international. But at the startup banking level, we're going to take care of you. We're going to give you the basic banking. We've got a team that's all over the United States. So it's a bunch of former entrepreneurs, investors, and also bankers that can give you advice, guidance, networks, investor introductions. And finally, we've got value beyond banking. And so beyond the insights and things we can do around that is also discounts to products and services that you need, whether it's AWS or cap table management. We have a free cap table management product and global shares as well. I can go on, but pretty much you want to be the single point of contact and the only bank you really need until post-IPO.
Thanks, Ashraf. Sale, how about you and Cooley's work with startups and investors?
Hi, everyone. I'm Kwon. I'm a partner in the Emerging Companies and Venture Capital practice group of Cooley. Cooley's a law firm. And my Stanford connection, personally, I studied psychology for undergrad and sociology and law after that, all at Stanford, and started practicing law at Cooley 16 years ago. For those of you who are not very familiar with Cooley as a brand, we're a full-service law firm. We've been around over 100 years and has really grown with the venture industry. So we cover all major practice areas that relate to venture-backed companies and their investors. So ranging from emerging companies, fund formation, M&A, cap markets, IP, litigation, you name it. So we're best known for our active presence in the venture industry. And in fact, as a legal advisor, we work with more companies for their venture financings and IPOs than any law firm in the country. We also work with investors of all types, from angels to institutional VCs, corporate investors, sovereign wealth funds, and help with transactions of all sizes, from 100K safe investment all the way up to a transaction that involves a change of control and worth billions of dollars. So about me, my day-to-day, I primarily work with founders and I help them form companies. As a legal advisor, I help them raise capital and also help them do commercial and strategic transactions all the way through a liquidity event, whether that's an IPO or a sale. I also work with a number of investors who are interested in investing in U.S. venture-backed companies, whether it's tech, life sciences, other industries, so long as they're going to be modeled as a venture-backed company.
Thanks, both of you, for the context. First, let's investigate general macro themes. As we start 2024, what is your outlook for startups? Are there key trends or shifts that you foresee shaping this year?
Get to know the macro environment, because it will define in many ways how you're going to react to it. We all know that public markets can be oftentimes leading indicators for how the private markets are going to respond, not always, but most times. And so at the macro level, the general sentiment on the JP Morgan side is it's going to be a challenging year. We think the first half of the year will be more challenging than the second half. We see some good tailwinds in the second half of the year, but it's going to be a little bit of a wait and see game. We think inflation's going in the right direction, but we're not fully out of the woods. We think some interest rate release might happen to 75, 100 basis points, but we still think it's going to be in that 4+% range. And so I don't think it's going to just go back to the years of 0% interest rates, right? So we think that that's there. There's a looming election that's going to cast some uncertainty in the world. So, and then obviously there's some headwinds around things like commercial real estate. We'll see where unemployment lands. But so there's all these macro things that I think that are going to keep it in the first half in terms of the year. And how that translates into, I think, the private markets and definitely with startups is like, think about how LPs are going to behave with that. Think about how your investors in turn are going to behave in that. LPs are going to be very specific on their asset allocation when rates are high to the alternative investment asset class. That's going to translate into access to capital for the VCs. The VCs are going to be very specific. They're going to probably go after a lot of inside rounds. Probably not going to have this quite as much in terms of their full interest in going outside of that. Now, the good thing I think for startups is I think with valuations obviously continuing to reset at the early stage, I think there's more interest in starting with the new value creation life cycle, right? Every 10-year recycling back into the early stage. I think we're in that early stage value creation life cycle. You're seeing that valuations at the early stage continue to hold. We're back to pre-pandemic deal count levels, which isn't bad. So I do think the startup segment is going to stay healthy. A reset back to the pre-pandemic levels is not bad. That's still great. And that's a top 5-6 year in the history of venture. So put it in perspective. And then there's going to be continued interest in specific segments. I do think, though, even though one would say, oh, consumers on the out right now, I do think that interest, right? Startups, the great thing about being the startups, people are much more receptive to going on your 10-year journey. So I would really say focus on what you love. Go do what you love when you're in the pre-A world, because you will have interest there, because generally good investors are going to want to be durable with you.
And I don't have a whole lot to add to that. I just want to echo the same observations. Although I'm not an industry expert, I talked to a bunch of people and all of them would say it's going to be a brutal year. Not all that different from 2023, but many are hoping to see some good signs, especially in the second half of the year when IPOs start to happen, driving exits and valuations. That can be a game changer, but no one's thinking 2021 will come back anytime soon.
SVB shocked in 2023. What surprises could you see in 2024?
So I can take that one. So I'm not aware of any surprise of the magnitude of the SVB bank run. If I am, I would be not in this profession. But one notable change that I would raise to everyone's attention is this Corporate Transparency Act, which took effect at the beginning of the year. So historically, the context is the U.S. never had a public registry of stockholders of private companies, and some foreign countries do. But the Corporate Transparency Act is essentially the U.S.'s attempt to increase transparency into who owns these private companies. So the Corporate Transparency Act won't require public reporting, but that it's going to require certain beneficial ownership information being reported to a government agency under the Treasury Department called the Financial Crimes Enforcement Network, or FinCEN. And we expect a lot of companies to be subject to this new requirement. So someone counted it, it's estimated over 32 million existing companies and 5 million companies to be expected to be created this year would be subject to this new requirement. And when a company is deemed a reporting company, the gist of it is that they have to report certain information about individuals who have substantial control or ownership in the reporting company. So you can start with C-level executives and whoever owns 25% or more of the company. There are some exemptions, but those apply to public companies, banks, insurance companies that are already reporting a lot of information because they're heavily regulated. The closest exemption is this large operating company exemption. So if you qualify, then you don't have to report under this requirement, but it requires you to have at least 20 plus full-time employees in the US and $5 million plus sales. So from an early stage startup perspective, it's not very helpful. In terms of timing, just to be practical, if you have a company that is formed last year or before, you have until the end of this year to report the information. If you're forming a company this year, you have 90 days. And after this year, you're going to only have 30 days. And if you don't comply, there are potential civil and criminal penalties. but it really remains to be seen how much it's going to be enforced. So long story short, if you have a company or plan to have a company this year, check to see if you are a reporting company. And if so, you need to make the reporting the information timely manner.
After a year of muted exits, what do you anticipate for M&A and IPOs in 2024?
2024 is probably not going to be up and to the right all the way from January all the way to December, and that it's going to be cautious optimism and a slower start and hopefully some green shoots as the year progresses. I think you'll probably see the same on the IPO side, at least to start, right? I think we had a slow year last year. A couple went out, but definitely not to the extent that we saw in prior years. We don't believe it's going to be a high watermark on the IPO side. We think that there's going to be healthy activity on the M&A side. I think there's a really decent amount of companies that are everywhere from early stage to late stage, some at the early stage that are probably not going to pivot into the late, and some at the late that are either tired of waiting or think that they've got great suitors, frankly, right? And so with that, I think we'll see some M&A activity through the year. So generally net, cautiously optimistic on the IPO side, optimistic on M&A.
On the M&A side, from my perspective, the market has been choppy. Last 2 years, exits and valuations have declined, as everyone knows. In transactions related to that, more companies are exploring multiple paths. So even when you're talking to a potential buyer, you're not counting out other possibilities. So you're still trying to raise money and you're still trying to look to go public at the same time. So you have your optionalities open. And in terms of structure, because the cost of debt is so high due to high interest rate, there's more interest in stock for stock acquisitions in private company M&As. So it's not really a liquidity transaction. If you're an investor, your investment in a private company is rolled over into another private company. But still, that you can understand why there's more interest in that. One other thing, deal subject to antitrust approval, therefore would likely take longer, and it's going to involve more transaction costs. So we think this will more or less continue in 2024 up until the election. And in terms of the IPOs, life sciences IPOs are still happening, although in a reduced volume. For example, Cooley advised on 10 out of 12 US life sciences IPOs, raising more than $20 million in 2023. Tech IPOs, on the other hand, have been essentially frozen. There were some good signs. In Q3, for example, we advised on Instacart's IPO, and there were some other good IPOs in Q3. But when Q4 data were disclosed, we saw IPO activities essentially came down. So when IPO is shut down, then there's not an exit, and it starts that cascading impact. But still, I'm optimistic because a lot of pipeline of great companies, starting with Stripe and all those great companies that no one would be surprised if they try to go public, and a lot of pent-up demand. So when it gets started, maybe in second half of the year, hopefully, then we think it can get normalized. But no one's really thinking 2021 would happen again. And when you're looking at a company trying to go public, there's definitely more focus and profitability for tech companies. And there's interest in seeing more data for life sciences companies based on what I've seen.
What dynamics are you seeing with funding rounds?
Quick thoughts. As you know, the VC market suffered a significant downturn last 2 years. What happened is if you have a company that was priced at the height of the market in 20, if you have to put a price tag on your company in this market, it's likely going to be a down round, right? So that's why for some time when there was a lot of market volatility and people were hoping that it's just something's going to happen and it's going to come back to normal, they were trying to avoid valuing their company by relying on a convertible financing, like bridge financing, where you would issue either safes or convertible notes instead of preferred stock. But then after 2 years, more and more companies have come to realize that this is the new normal. And now deals are happening, assuming this is going to continue for the time being. So more and more companies are doing equity rounds where they actually price their companies. So that's why we see more flat and down rounds, and we expect to see more of them. And given the VC market being pretty brutal, I mean, obviously it's relative, but I think it's coming from 21, it's very slow. So a lot of times investors would just be more picky. So what that means is investments into new portfolio companies have reduced a great deal, which means if you are a company that ran out of cash, then what you are looking at is likely an insider round. So we're definitely seeing more insider rounds, and insider rounds obviously create some complexity because if you are pricing your own company, it's self-serving. So how much credibility can you give to the terms and valuation you're setting with yourself, right? And obviously everyone is seeing race to the top. So founders with proven record and or backed by brand name investors are dominating, and there is some bifurcation between them and the rest of the pack.
I think the two things I would, and this is from just what I've seen and just conversations I've had with founders, is a little bit more optimism at the early stage. And even if you look at some of the data, right, valuations not only were steady, but they were they upticked this year, which to think anything uptick, but to see the pre-A market, you've actually seen an uptick in valuation. So that was a surprise. So I think at the early stages, again, I think there's optimism because you still have the duration of 10 to 13 years of equity runway. I would say that a lot of founders are starting to get smarter about going for the top valuation at the late stage. We obviously saw some of the unfortunate news over the last couple of days, right, of tech layoffs and things that we're seeing in the news wires. And I think the general idea of growth at all costs is something that some founders are considering and reevaluating with investors, which is, look, you're not going to stay private for only 6 years in IPO anymore. You could be private for 13 years, which means you have to consider growth, which means that if you're going to market at the top and you're going to continue to stay private and you can't show that growth, that's a problem. And so what does that imply in terms of then a potential exit into the IPO market? Not the greatest way to enter. So I think that there's a bit of more of a cognitive reality check as to whether do I want to constantly have to grow into my valuation? And that then translates into the conversations that are being had at the late stage.
Shifting to early stage sector insights, what types of businesses and founders do you believe will thrive now? And what strategic considerations should they keep in mind?
It's a great question. I would say about early in the years I've been in it, which is many, is you can read all these things about serial entrepreneurs or a disproportionate amount of what you're seeing now too early, blah, blah, blah. But it's passionate entrepreneurs that really care about what they're looking to do and how they're looking to change the world and what they believe that the world doesn't have that they think they can offer. I think if you're going to go on a 13-year journey and hear no, and that's not the right way to do it for 99% of your day, you better be completely passionate about what you're doing. And so I do think the age-old, you don't invest in the idea, invest in the founding team, I think continues to be the case. I think it's all the more important right now that be the case. And so this is the next cycle. A lot of investors are taking that bet on these early stage founders, and they're going to want to know the best founding teams that care about their ideas are the ones that are out there for the picking. So that would be before anything else, before I think about, it should be an AI company, or it should be a gene or cell therapy company, or it should be a climate tech company, or whatever interesting thing we're going to say. I mean, if it's an amazing consumer company in the disruptive commerce segment that really believes in what it's doing, is a founder that's seen it, been there, done it, made mistakes, and is coming back, has a great investor network, knows the right GPs and consumer, that'll get funded.
Yeah, the only thing I would add to that is now there's more focus on fundamentals. So even for early stage companies, they are really looking through, in addition to who else is investing and who do you have, but they also really need to understand how you're going to monetize and all that stuff. And the other thing I would say is VC is highly personal. It's based on a lot of personal networks. So those investors who are successful at raising money from good institutional names, they are really good at building relationships and keeping in touch. And just when they speak in a way where you feel you can trust this guy. So it's highly personal. So it's not necessarily about the greatness of your technology. It's all about your ability to connect with investors on a personal level.
Yeah, I totally agree with Sal. Just to double down on what he's just said, because I think it's really important, that path to profitability conversation, I would call it, we are in the cycle of path to profitability questions. And I say that not justly, but to say it's a tougher environment. Yes, there's a ton of dry powder out there, but valuations are coming down. No one wants to catch a falling knife. So that conversation around your path, maybe not at the pre-seed round, but at the seed and working your way to an A, they want to know that you're starting to have that conversation for sure. When you're going to raise an A round, they're going to want to hear it. And so definitely it's there. The reason why I say it's a cycle, I'd say, is it going to be as strong in 3 years if the market comes back and we're in great shape and stuff? Probably less of it. But right now, that's where we are. And so I think a great founder at the early stage should just, in general, durably understand their operating model and how they get to profit.
What looks most exciting to you now? Where are you seeing the most innovation?
I'm going to be the sort of the contrarian with my first kickoff on this, but like I have a bias for NorCal. I've been here for a long time, and everybody likes to hate on it. And right now, it seems like that's a good thing to do. People are moving to Austin and Miami and whatever, but you kind of forget that 52% of invested capital thereabouts, but based on latest, is still happening in California. So I'm really bullish on, if this is what down looks like for California, I can only imagine what up's going to look like. So I'm really bullish. I'm biased. I've been here a long time. I've gotten to see, and it's just not an ecosystem that you could build overnight. So from a geo perspective, Obviously, really excited about what's happening in Miami and Austin and New York and Boston. Those continue to thrive. The Midwest, you're seeing stuff. You saw some amazing uptick. I think it was over $500 million of invested capital in Philly, I think in the last quarter, which is pretty amazing. So you're seeing upticks in some of the other geos. And then from a subsector perspective, the obvious ones to me is cyber, life science, especially cell gene therapy, obviously climate tech, quantum computing, and just edge computing is another big one. Enterprise is a durable model right now. Obviously, always innovating, and at a cycle like this, enterprise gets really interesting. But again, a really great consumer idea is super contrarian and still super exciting to hear. It's really, honestly, this is some of the most amazing times in the innovation life cycle that I've ever experienced, and I've been doing it for a long time. The next 10 years, I think, are going to be more exciting than the prior 10 years from all the innovation we're seeing. So I'm an optimist. There's a lot to be excited about.
Well, what areas do you think might still be inflated?
When the market's down like this, it's easier to answer this question in 2021, like when crypto went crazy, like generative AI went crazy. But I would say like generative AI has a lot of following right now, but there's, in my mind, not always clear understanding around how it's distinguished from AI that pre-existed it, right? So people talk about generative AI as if OpenAI created it, but a lot of people would say it's a concept that pre-existed it. So why suddenly all the craze? That is probably something that is worth thinking over.
I totally agree, Sale. And I would say, you could just take the statistics around down rounds, right? And we know, I think it was roughly 20% of rounds were down rounds. And if I look at just using that from a data perspective, it's the standard fare that we all probably expect. You're going to see in markets like this, you're going to see some of this really cutting edge, high conversation pieces like crypto and web are going to take a hit. So that was above the 20% mark. Consumer, I've mentioned a couple of times how I'm feeling about where that is on the valuation curve. That obviously took a hit. Education and health tech took hits. FinTech in general was right there. Those would be the ones that I would say you're seeing that post pre-adjustment frothiness that you're seeing now. And then obviously the ones that are going to get the largest amounts of investments like artificial intelligence today will most likely see potentially some valuation corrections later because there's a lot of investment in it. So I saw some crazy statistic, 52% in some specific quarter, 52% of invested capital is going into AI. It was crazy, like at the Series B, I think is what it was. So that's a crazy statistic. And so you're going to have these areas that are going to get overinflated and they'll course correct. So be clear, we're in the alternative investment asset class. Our idea is volatility exists in this market. We're not in the left side of the efficient frontier. We're playing in technology and life science, playing in the edge of innovation. That's going to have volatility and variability. It comes with the territory, but that doesn't mean that the foundations, the fundamentals of these segments are not good. They're great.
Reflecting on 2023, what was notable in VC financing structure, and how do you expect these trends to evolve in 2024?
Again, it was a tough market. It still is. The negotiation leverage in that sense has shifted to investors. It's less so in the Bay Area, but outside the Bay Area in other jurisdictions, a lot of investors are requiring a lot of so-called structure. And it presents itself in many different forms. But a couple of things I want to highlight is we saw a lot of financings involving so-called a pay-to-play structure. So pay-to-play is essentially one way to incentivize existing investors to further support the company financially. So if the company is trying to raise a new financing round, they would just pass the head around and say, hey, you own 10% of the company. Why don't you do 10% of this round? And if you don't, then you are subject to a certain penalty. And most commonly, that penalty involves converting your preferred stock into common stock. And in the process, you would lose certain preferred rights, starting with liquidation preference associated with your preferred stock. So that's one thing we've seen. And the other thing I've seen, it's more pronounced in life sciences, I would say, is tranche financing. So instead of an investor saying, oh, I give you $10 million right off the bat, I'll give you 5. And then if you meet these milestones, then you get the latter half. So it's a simple concept. It's not very common in good economies or in tech, but in life sciences, we're seeing more and more of that, because in life sciences, a lot of things are milestone driven. But if you don't, so in the sense that if you don't meet the milestone, then it's sort of binary, right? It's all or nothing. So that's part of the reason why I think we see more milestone based tranche financings in life sciences. But in looking into 2024, I believe it's more or less going to continue. Hopefully, it's going to come down as market unfreeze. But for the time being, that's where I am.
And I would say even on the debt side, right, structure is going to be there. So in the venture lending and the debt lending, on the lending side of the house, you're going to see structure show up on the term sheets as well. And so there's pretty reasonable correlation between, let's say, I'll say on the equity side and what you're going to see on the debt side.
Generative AI dominated news waves last year, sustainability the year before. Where do you see funding in these spaces heading into 2024?
Yeah, I wish I had the crystal ball, but I would say I don't think AI is done. I really don't. I think there's a ton going on there. We haven't hit singularity. We haven't gotten to general artificial intelligence. So that's still going to be part of the conversation. I think there's a lot that you're still seeing in auto tech. You're still seeing stuff in space tech. Cyber is top of mind. We're seeing a lot of geopolitical uncertainty. And I think cybersecurity is not only on the enterprise side, which is always a bellwether in a down market, but it's also now contemporaneous with geopolitical uncertainty. So I think cyber will continue to be a strong play beyond just the general AI space. And then I don't think we're done with sustainability and climate. I think those are going to continue to get dollars. And then on life science, biotech, you heard me talk about it, with the amount that's even going on in AI and ML and big data, that stuff is starting. The technology side, remember the crossover investors a couple of years ago? They're always just going to be a couple of years before the reality of how things are swinging. I think the reality is really starting to set in that the distinction between tech and life science is going away in many areas. And the fact that in many ways, life science needs technology is happening. So I think with the rise of AI, with the rise of large data stuff, you are going to start seeing continued, I think, interest on the bio side because you're going to see faster and more methodical advances on that side.
Rolling up our sleeves, let's talk tactical strategies now. Are there notable shifts in the approach to financing startups?
On that one, when you're looking at early stage, I would totally second what Ashraf said earlier. What's interesting is you would expect to see a lot of changes in valuation and terms, but you're actually not seeing them. And my theory is that if you're a company raising money for the first time and you're talking to an investor, and if you're in a situation where you have to agree to distress terms, then investors would rather not invest. So that explains why the volume came down. But when it comes to early stage companies that got funded, their valuation is good and their round size is normal and terms look standard. So we're just talking about companies that got funded, but numerous companies are being passed over. And I'm seeing it a lot. So the market is hard, but at the end of the day, we are still looking to see a lot of investors coming in the form of a SAFE. So it's a new trend, relatively recent, and it is becoming more and more dominant every year. The genesis is that they wanted to essentially replicate an equity version of a convertible note. That is essentially the genesis of it, but I don't think it fully explains the wild popularity of SAFE. Actually, on the ground, the reason I love and a lot of people love using a SAFE versus a convertible note is because not only because it's equity and doesn't come with features like interest rate and maturity date no one cares about, it is more about there's actually a form that is final. And if you actually go to YC website, there are 3 forms. So you pick a form, fill in the blank, use it, get funded, easy, right? But when you're talking about a convertible note, a lot of people are sophisticated enough to know and discuss all kinds of variations, but there's no one who can point to a form that everyone should start with. So what that means is, oh, let's do a convertible note. And then for a SAFE, you can just fill in the blank and sign. But for a convertible note, that's only the beginning. You now have to talk about the terms, like what should interest rate be and all that, so on and so forth. So I think if anything, the popularity of SAFE would really increase over time. And then the amount you can expect to raise using a SAFE used to be a lot smaller. But these days, I regularly see raising millions through a SAFE. So I think that's very efficient. Obviously, you need to know ins and outs of how SAFEs play out over the course of the life cycle of a company. But I think it's a desirable trend.
On a separate vector, I'd say you look at the availability of investors and then financing options. But let's start with investors. Look, I think nobody's going to sit here and tell you that emerging managers are going to be up and to the right and we're going to grow the emerging manager space like gangbusters in 24. I think that would be foolhardy, right? In these cycles, we see it. Emerging managers are going to be under pressure because family offices are going to probably be the first to asset allocate and figure out and rationalize how much do they want to put into the alternative investment asset class. Is it a durable family office or not? And that's going to have consequences on the EMs. And some EMs that wanted to come to market might not decide to come to market with their first raise this year. They'd like to wait until they could raise the proper amount of dollars to actually deploy in the way they want to. So I think that the EM space will probably be tighter this year, and that will translate into maybe some availability of deployed capital, right, for founders. I would also specifically debt, let's move away from equity for a while. I would say getting pre-seed debt, number one, is not always favorable, and VCs oftentimes don't want you to get that early. They don't want you to service it. They don't want you to think about it, even if it's an IO. It's just not necessarily what a lot of investors would want. So those are things that you'd want to talk to your investor about if you're going to think about seed financing on a pre-A basis. Then I'd say that there are marketplaces and there are fintechs out there that do have an interest on financing in the pre-A. Those are available and those weren't there 5, 6, 7 years ago. So there's positives and negatives. There's a larger pool of potential opportunities to get capital. I think the job of founders to know what those available pools are and then use great advice from either existing investors or founders, or like I said, or even a Cooley, who know what those various funding options are to make the right choices. The decisions you make on who you take money from and the platforms you take money from can play a big role in the interest at the A round.
How will the syndicated angel investment approach, such as through SPVs, fare in 2024?
So on that, I expect the syndicated approach through an SPV will continue to be popular among angels. So on the one hand, the company doesn't want to have 50 angels, individuals showing up on their cap table. It just is bad optics and investors get worried. So that's one benefit. And also from angel perspective, if you're cutting $10,000, $15,000 check, you're not going to get meaningful rights. But if you syndicate such that in aggregate, this SPV itself is going to put in millions or something like that, then obviously and naturally, it's going to get you more information rights or other similar rights. And so that is why oftentimes syndicated approach is preferred. And there are some drawbacks that needs to be considered as well, because first and foremost, the cost of syndication is not free. You're talking about another layer, another entity that someone needs to pay for it, someone needs to register it. But on that one, we've seen a lot of technological advance. And in terms of platforms, there are Encarta and those guys who make it very automatic and user-friendly. So I think in that sense, friction or transaction cost has come down on the syndication front. But the other challenges still exist. Number one, it's indirect, right? So if you're an angel, you don't have direct privity or relationship with the operating company itself because there's an extra layer between yourself and the operating company. So if there are certain rights, there's no guarantee that you'll actually enjoy those rights, whether it's pro rata rights or other type of rights. And in fact, one of the popular offerings say, hey, we can get you syndicated, but you have to give a voting proxy to the founders because you're not expected to have any voting rights or blocking rights and so on and so forth. So it's usually not a deal breaker, but at the same time, something that needs to be considered. And from the company side, if you're a hot company and have sophisticated advisor, they often are alerted to the concern that you don't necessarily know who owns the SPV because the SPV will show up on your cap table, but you don't know how they're going to share information the company will provide to them. And also, if someone were to do secondary transactions at the SPV level, meaning an angel will transfer their equity stake in the SPV to another person, the company doesn't automatically get visibility to that. And then they just don't have control over who owns the company ultimately, which is a concern, especially given the Corporate Transparency Act that we were talking about. So there are some drawbacks, but the technological advances, as I said, are making the syndication approach easier and easier.
One more question before we jump into the live Q&A. What changes, if any, have you seen founders make around cash management?
Pretty material. When I first got into the startup banking space years ago, and the archetypal founder would call and just talk about the fact that they needed a digital mobile experience really fast, and then focus a couple of years later. And by the way, basic banking, but that's about it. Give me basic banking, maybe a card, obviously a DDA, and call it a day. Then you saw over the last couple of years as rates increased, right? You saw conversations around yield. So I'm going to get on my DDA. And oh, by the way, if that's all I can get, how about an MMA? And let's talk about that and what's the yield on that. And so yield became the conversation. And then obviously with some of the unfortunate incidences of last year, safety and soundness have become a really core part of that conversation. So things I'm even hearing outside, it's not just the founders. Part of that pressure is coming from the LPs that are putting the pressure on the investors that are then putting the pressure on the founders. It's also in the narratives of a lot of marketing collateral out there, whether it's from fintechs or what have you. But I think what you're hearing now is really about safety and soundness. So I'm hearing a lot of founders talk about treasury and sophisticated treasury and treasury that's safe and treasury that's accessible. And so a lot of that conversation now, I'm hearing a lot of JP Morgan. Now, I'm really thankful I'm on the JP Morgan platform. Literally, we have commentary that says we take the fortress balance sheet. You'll hear in our narrative, the fortress balance sheet. And what we talk about that is from ad infinitum. This isn't just a last year thing. From the duration of JP Morgan's life, it's always been about the safety and soundness that the clients deposits come first at all costs. We build our business on it. We make sure our employees understand it and are trained on it. We make sure we offer the very best treasury product services on balance, off balance, to make sure that safety comes before anything else. So that, I'd say, has been a fundamental shift over the last few quarters, and I don't expect that to recede.
That point is that investors often, especially at the heels of the SVB bank run situation, there was definitely more interest in some cash management policy or investment policy on the part of the company. And as you can imagine, when we dial back and relive the moment, a lot of startups didn't have multiple bank accounts. They only had one bank account, and that was with SVB. So initially, there was some trend where policy should require the company to have multiple bank accounts, so that just in case, right? And also the other thing that was really on the news every day was this FDIC insured amount limit. And then there were products, and I don't know if that pre-exists SVB bank run, but there is a product which is synthetic in the sense that even if you are putting money that is over the FDIC insurance limit, the bank will diversify on their end so that the entirety of the amount would be covered under that. So there was some trend to put that as a covenant in the financing documents. I don't know if that's going to get as much attention these days, but you more often than not see that in financing documents. So as a founder, you probably want to be aware that that may be one of the things you have to consider.
Yeah, and I would say, like sales saying, there could be things, it's the versions of it called insured cash sweep or something like that. But those products, you have to really think about, was there a minimum? Was there a footnote? Was there a minimum or a maximum that I can put in it? Because if you're not reading it, you might not know. And then you might have more money and it's not going to be in it. Or you might go under because you're burning cash and you haven't raised around it and you're going to get hit with fees or whatever it might be. So just make sure you're reading the nuances of these treasury products and that you're on the right platform that's got a lot of, that has the durability to not have all these nuances on that stuff. And then the other thing, it's not just about having it, it's about how can you access it and how quickly can you access it. So definitely look at the fine prints around speed of access.
It's time for the live audience Q&A. What footfalls should early stage founders watch for this year?
Well, one thing I would say is there are a lot of automated solutions and product offerings that are pretty tempting if you're a founder, because it really helps reduce costs. So the ultimate question is whether you can actually achieve the desired efficiency without sacrificing low quality. And on that one, I often see people penny wise and pound foolish, because startups, and when it comes to law, the norms go a long way, because rules don't really tell you in each specific situation what you have to do or what you're expected to do. So my advice usually is stick with proven advisors and platforms, because among the number of platforms, there are some platforms that were used more often by the founders and there are more trial and error, and then they know the quirks, so what issues are expected and how to address them, versus less proven platforms, which often come at a lower price. So that is something I would mention. The other thing is, as we went through the COVID era, you see more geographically dispersed workforce. So a lot of times you have folks in out of state and other foreign jurisdictions even. And sometimes people don't realize, especially if you're a first-time founder, how complicated it would be to have workforce around the globe. And it sounds cool and sounds like tech, right? But it is difficult, because I recall talking to a founder. He says, oh, I'm a Delaware corporation, so my employees are subject to like Delaware law, US laws, right? And I tell him, no, employees are subject to the laws of the jurisdiction they live in. So if they live in Canada, they're subject to the laws of Canada, and you have another country's laws to worry about, right? So that's why it's important that you be careful in terms of complying with applicable local laws. The other thing is, giving equity to people in foreign jurisdictions is a very complicated business, because securities laws is a little bit antiquated and it's highly regulated, and each country regulates it in different ways. So whenever you're trying to give equity award, most often a stock option, let's say, to a company, to a service provider outside the US, the textbook approach is you have to get counsel licensed in that jurisdiction and have that counsel look at the paperwork and tell you that this is good or this is not doable. For example, in certain jurisdictions like China and Russia, the stock options cannot be given as you would expect to give in other jurisdictions like the US. So you need to do that diligence. And then the next question I get is from a founder is, oh, that's too expensive. Makes no sense. It's just one employee. So my usual response is, that's why it's difficult to have workforce around the globe. And number two, if you want to comp them, maybe do cash comp, which is comparatively speaking more simple than equity comp, which is subject to securities laws.
How will venture capital compete with other asset classes offering similar adjusted returns with lower risk?
Look, I think it's going to be there, right? Venture capital will have to compete. That's the reality. So we will see that. We will see some, like I said, early stage investors mostly, but you might see it in the expansion stage and even in the late stage. Because again, who knows? Maybe there will be some in private equity that decide to go elsewhere or reallocate. It could be that you might see some sovereign wealths take a different direction. So the ones that are direct LP investors, who knows? You might see some corporates decide that they're not going to lean in as heavily as they did in the past. Those things will happen. They're part of cycles, and that could be the case. But at the end of the day, I still go back to the trillions of dry powder that still exists between both private equity and venture capital. I really don't worry about that. Yes, the valuations are at the late stage are coming down, and there is an adjustment in there. And because rates are up, you can start implying that there might not be as much access to the liquidity, but it's there, right? And we saw that we're seeing that with AI. Like there's plenty. It was something of the 170.6 billion invested in 2026, which mind you is a top 5 year of all time. Something a little south of 20 billion just went to OpenAI and Anthropic. Okay, so when investors like a segment, they'll put their money there. So I really focus, just cut the noise and just focus on your idea, what you're trying to do, who you're trying to serve, why you think you're a great founding team, what your path to profitability is, and how confident you are in that path. I generally think that with a $170.6 billion 2023, I think there's enough money. I don't worry about venture going away, and they're still raising.
What tips do you have for angel investors in this market?
Yeah, well, one thing I would say is I see angels more and more trying to distinguish themselves. So competitive rounds led by household name VC investors is by definition always going to be oversubscribed. So when I see angels coming in, I often see they have personal ties to the founders. Obviously, that's not something you can control readily, but oftentimes they get in just because they really sold the founders on their ability to help them with the next round of financing because they're highly networked. They know a lot of good people in that industry who's experienced in investing in companies like that. The other fact pattern I've seen is these are experienced operators, repeat founders who exited companies hopefully in a similar situation, and they would say, "Oh, take my $10,000 or $100,000, and I'll be your informal mentor or advisor and helping you guide through your journey." So that's another way you can distinguish yourself. And obviously, there are 1,000 different ways you can do that, but it's not enough for an angel investor saying, "Oh, I have the money, can I just have a seat at the table?" And that strategy almost never works. The other thing I would mention is angel investors are not expected to know the norm and what is reasonable, because without knowing the norm, you don't know what's reasonable, because there are a lot of things you can think of that is favorable to you, but without knowing what is normal, and you run the risk of asking for something that is essentially off market. So I'm here to tell you, essentially, angels don't necessarily get governing rights, and sometimes they get limited voting rights as well. But one thing I would say is you still need to be very clear on what rights or lack thereof that you get that comes with your shares. And especially when you are an individual who is thinking about some transfers for estate planning purposes, put your shares under trust name. That sounds innocuous, but transferring shares of a private company is harder than most people think. It's highly manual. It requires a lot of contractual review. So before you invest, if you're looking to sell secondarily in the near future, or you're thinking about estate planning transfers, then you at least need to familiarize yourself with potential approval requirements or transfer restrictions that may apply to you.
Last question from the audience here. What quality resources are there, free or paid, for first-time founders to use so they can focus on the problem they're trying to solve and outsource the startup-related issues?
So there I can throw up my hand and say coolego.com. So coolego.com is where you can find a lot of stats and articles. And those stats are based on 1,500 venture financings that we advise on an annual basis. So it's going to be highly helpful. And obviously, ultimately, if you're looking for tailored advice for your situation, you have to find a legal advisor that actually can give you that advice.
Yeah, and obviously, I'd be remiss to not say that's the whole means of the existence of the startup banking team at JP Morgan. We are not just this digital only portal that you go and you just pop in. You want to look at your analysis, you see your balance, and then you wire some stuff on your phone and call it a day. We're human beings that have been there, done that. We've been through multiple cycles, and we could help you with the financing, the networking, the events, and really help you focus on what you need to do and leave the rest of it. And happy to help you uncover some of those natural paths that can make your life easier along the way.
Excellent. Thanks very much to Ashraf Hebela, MBA 03, Head of Startup Banking at JP Morgan, and to Kwon, JD 08 and partner at Cooley LLP's venture capital practice, for joining us today. We greatly appreciate your time and insight. You covered so much ground. It's unbelievable. The time has passed. Thanks again to our guests and to the audience for joining us.